Welcome back to the 2021 Virtual Iowa Renewable Fuel Summit. We hope you enjoyed the morning session, and we're excited to kick off the afternoon panels. I'm Devin Mogler, Vice President of Government Affairs for Green Plains. Green Plains operates 12 ethanol plants, including 2 in Iowa. I also happen to serve as the Vice President of the Iowa Renewable Fuels Association. Joining me today is Dr. Seth Meyer, who recently returned to USDA as their new Chief Economist after a 2-year stint with the Food and Agricultural Policy Research Institute, known as FAPRI, at the University of Missouri. Dr. Meyer has served in many varied and important roles over his career, but I should note that he grew up in Iowa and earned his master's degree from Iowa State, also my alma mater. Why he chose to pursue his PhD in Missouri is unfortunately a topic we won't have time to dig into today. Also joining us, we have Josh Pedrick, America's Biofuels Managing Editor for S&P Global Platts. Josh has covered fuel markets during the changing political trends, shifting global policies, and economic upheavals like our current situation impacted by COVID-19. It's probably been since the commodity bubble burst in 2008 that we have witnessed an event like COVID-19 that simultaneously threw both biofuel and petroleum markets into utter chaos. With the rollout of COVID vaccines beginning, we are optimistic that the worst may be behind us. But both domestic policy and international trade issues still loom large. What will be the new normal for biofuels and petroleum? Let's find out. One quick note, please use the chat function to submit any questions you might have. So diving right in, Seth, in 2020, we saw domestic ethanol usage slip from a normal 14.3 billion gallons, or approximately 10% of the fuel tank, to 12.4 billion gallons. Even the rosiest of projections have us staying below 14 billion for 2021 and 22. Do you agree with this outlook, and have we reached peak ethanol?
I think the biggest factor. So we have our forecast. My group that puts together the WASDE report. They're looking out at the 2021 crop year, and I think that the biggest driver here that'll determine the corn grind and how much ethanol we produce is motor gasoline consumption. So, it's hard for me to determine how much we'll actually blend, and it'll be driven in large part by motor gasoline consumption. Right now, EIA is saying, 137 billion gallons of motor gasoline consumption, a good rebound. And I think that's the source of most uncertainty. I'm sure we'll get into talking about policy, also important, but that's the biggest factor, motor gasoline consumption. And have we hit peak ethanol? I think that there are some headwinds which are developing. I certainly think that we don't know how we're going to evolve from COVID in terms of folks' driving habits. I don't know that we've reached a peak, but I certainly think we won't see the growth we've seen in the past. I think that that's probably a pretty solid guess. Again, I think that policies both in the past and how they evolve in the future will tell the tale on that.
If I could speak to that, I think that Seth makes a really good point there. Ethanol demand is really a function of what gasoline demand does. And it's almost certain that we're going to see a rebound in gasoline demand over 2021 compared to 2020. Our analytics group thinks that gasoline consumption is going to be about 136.9 billion gallons. And so when you think about 14 billion gallons of ethanol, it's easy to talk about ethanol as kind of round whole numbers, but we have to remember it's a function of gasoline demand. And so it's often better to think of it as a percentage. And 14 billion gallons would only be about 10.23% of that gasoline demand projection, which isn't out of the realm of possibility. I think it is maybe a little bit high. I think our analytics are expecting more like 10.1%. But that means that 14 billion gallons is achievable. It is attainable. It's not outside of the realm of possibilities. It would just definitely be a challenge, though. And when we talk about peak ethanol, again, that's really, are we at peak gasoline? Well, compared to 2020, we're probably going to be higher. Whether that tails off in the future years, our analytics has it still climbing ever so slightly, but it'll be a challenge to see where gasoline demand shakes out over the coming years.
Yeah, and by that, Josh, I was kind of balancing between, okay, how does 2021 look for ethanol? To me, it's motor gasoline consumption, and not in the short run, kind of the RFS that the EPA originally puts out, because they'll be tweaking around that edge. I think it will be they use the projection for motor gasoline in order to determine what the percent inclusion rate is and the volumes at the end of the day. But to me, the big factor that's going to push the grind is, again, motor gasoline consumption.
So following up on that and pivoting to the production side, if we call the domestic production capacity somewhere around 17 billion gallons, and with the drop off we've seen in exports recently, we'll call it 1.3. So even if we're optimistic and say 14 billion gallons are getting blended domestically, obviously the market's not in balance. So how do you see this playing out going forward? Will we see more biorefinery shutter or pivot to making other types of alcohol? Or do you foresee the demand coming back to meet that need? Josh, we'll start with you.
Yeah, I think when you talk about capacity and 17 billion gallons of annual capacity, it is just that, it is capacity. And it's not necessary to think that a refinery or biorefinery has to completely shut if it can't produce 100% of its capacity. I mean, in the oil complex, we see a refinery will trim its run rates. It's not going to completely shut down necessarily. Now, that is not to minimize the margins that producers are facing right now, which are extremely challenging and are going to remain challenging in the coming months, it would seem. But when we talk about complete shutdowns, some of the less economical plants, some of the destination plants, I think will face some serious challenges as they tend to when feedstock costs go up. But we don't necessarily have to see plants completely shut down. I think that we would expect to see run rates trim and production below total capacity rather than plants just running at 100%.
That makes sense.
Yeah, and I'm not sure. I think that's great. I'm not sure I could add much to that. Maybe when you think about exports, but perhaps not surprising if transport demand around the world is lessened, and at the same time, corn prices getting awful expensive here in the United States. So I'm not sure I could add. I couldn't do better than that. It was a great answer.
Well, exports were part of that question, and I don't want to steal all the thunder from our following panelists. But if we look at Canada, which is our largest ethanol trade partner at the moment, you have Manitoba, which had a mandate that went into place, increased here at the beginning of the year, and Quebec is eyeing a mandate that would start in July. And so you could see some support to exports there, especially with a trade partner that is so close and it's logistically a little bit easier to get ethanol across that border.
And I mean, a lot of those, you've got to mix. Most of those destinations are policy driven, as you just indicated as well, too. And so some of this relies on oil prices, but given where they're at least today, again, I think that exports is one of the place where you could see some additional growth longer run. But again, I agree. We're just the idea that will push that capacity this year or that everybody will come into full production probably isn't realistic.
Got it. So this was touched on in one of the earlier panels, but Seth, there's been a lot of debate around the true impact on biofuels demand of some of the small refinery exemptions that were made over the last 4 years. In your eyes, how did that impact actual ethanol and biodiesel demand? And looking forward, how do you think the Biden EPA and USDA will be handling those billions of waived gallons?
All right, so I can't. I'm a career civil servant, so I won't talk about policy. I won't speculate about policy, but I will tell you, I have folks come out and say, well, demand is where it's been, and so there's been no demand destruction. And I'll put this in terms an Iowan can understand. If for 4 years your corn yield stayed the same, would you say that was a success? You would. You'd say, I should have seen grow. It should be growing over time. Okay. So when you think about things like small refinery exemptions, uncertainties associated with those small refinery exemptions, these are things which hold back growth in this industry. So I don't think it's fair to say, hey, demand has been flat. There's been no demand destruction. You got to look at how was the program designed and what should it look like? And when Josh is talking about what does domestic demand look like? Remember, there's a huge stock of RIN sitting out there, a result of those small refinery exemptions. So if you start ratcheting up inclusion rates in the short run, the natural reaction isn't going to be to blend a whole bunch more ethanol, which is difficult. It'll be to dip into those credit certificates, and you don't see that increase in demand if folks aren't sure that pressure will be maintained. So, where will the administration go? I think that that's something that the administration will decide. But I will tell you, I was here at USDA in the original Vilsack administration with Sonny Perdue, and now back with Vilsack again. USDA understands and plays its role when it comes to EPA. Really, I've been in meetings where it is clear that the folks at EPA understand the rules at least as well as the folks across the table from them.
I mean, I am sitting here in Houston, which isn't as far from Washington as you can get, but it is a long way. But I will say it does seem like things are in a little bit of a holding pattern right now while we wait for the Supreme Court to really look at that 10th Circuit decision, which, to be honest, I mean, talking to a lot of people, especially in the market, they were pretty surprised that the Supreme Court picked it up at all. There was a bit of an expectation that they would just say, no, we're not going to take a look at this. So the fact that the Supreme Court is going to review it took some people by surprise. But it doesn't seem like there's a whole lot of will to make any big moves on these exemptions until the Supreme Court makes a ruling in that case. Because you don't want to go do something that then you get in trouble for down the road because it conflicts with a subsequent Supreme Court decision.
Yep, that was certainly another curveball. And just, Seth, to your point earlier, regardless of which party's in charge, there's been plenty of uncertainty in the administration of the RFS, which regardless of who had the White House, who had Congress. Josh, turning back to you, renewable diesel is all the rage, driven largely by the California low carbon fuel standard and investment from petroleum companies, some building greenfield sites, some retrofitting some of their refineries. Where do you see this market going, and what would the impact be on biodiesel producers, feedstock producers, including ethanol plants making corn oil?
Yeah, I mean, I think that there are going to be challenges for some of the existing biomass-based diesel production that's out there. The way that our analytics are looking at the growth of the biomass-based diesel industry, some of the growth in total, the D4 category, comes at the expense of traditional biodiesel. It is going to be taken up by renewable diesel. And part of that is, I mean, you have completely new players in the space, right? You have petroleum refiners who are getting into this world, and they might bring some more heft to their negotiations with feedstock suppliers. They might be able to outbid for some of those feedstocks compared to the traditional biodiesel producers. So I think there's no way getting around that. That's going to be a challenge in the coming years for all of the feedstocks across the board, whether that's some of the lower carbon feedstocks like tallow or used cooking oil, or some of the virgin vegetable oils like soybean oil and distillers corn oil. There will be an interesting interplay there when it comes to distillers corn oil. Is there going to be enough demand from renewable diesel that it keeps ethanol plants producing when it might not be as viable on the ethanol side? I think that's something that we're going to have to continue to keep a close eye on, is the byproducts and co-products of ethanol production. I think have seen a lot more support through 2020, whether that was the carbon dioxide, whether that was DDGs, which have surged to some pretty impressive numbers. You might see the exact same pattern in distillers corn oil, where there's so much demand for renewable diesel feedstocks that you're going to have to just produce more and more. In terms of where it's going up. One way or another, you have production coming online, whether, Marathon's Dickinson plant that's, being fully commissioned right now, CBR, the Bakersfield plant, Holly Frontier has their plants that they're expecting. There could be a challenge for some of the people who announced interest in either converting or building a greenfield site that are toward the end of when all these plants will be coming online. I think some of those, there is a little bit of a question if they will make it all the way to the finish line, because there might just be enough supply hit the market before they come online that it would really challenge them economically to bring the project all the way to completion. So we'll have to see if especially those later plants make it all the way up. But there are definitely several plants in the pipeline that are going to bring renewable diesel production to the market within the next year or two.
So does the LCFS and the ability to send corn oil biodiesel to, back end corn oil biodiesel to California make any difference for those folks? Keeping that process in line? Because you can get double credit out of LCFS.
It depends. And it especially depends on where policy moves go, right? Because California right now is the LCFS, and then you have Oregon, but the credit prices simply are not the same as California. But if other states expand their programs, and if they expand the stringency of the targets under those programs and credit prices kind of even out. I mean, the reality is the entire landscape could change in the next few years depending on how those programs evolve and develop. Both Canada and Oregon, the credit prices are just simply not what California's are. But there is renewable diesel that goes to Oregon and up to Canada. There's no getting around that. So, one way or another, I think renewable diesel can find markets, even right now, where there's only one really expensive LCFS program in the nation. And if that changes and you have additional ones, renewable diesel is going to find places to go.
And
regardless of feedstock.
Yeah, regardless of feedstock. Seth, from a feedstock perspective, do you have concerns that those new refineries for renewable diesel could suck up all the traditional biodiesel feedstock, or does it start competing with edible vegetable oils? How do you see that playing out?
I think it again, I think part of this, again, is we go back to both policy in terms of, there are no rules with respect to the RFS and how much those volumes must increase. And that has been one of the places that we've seen support for biodiesel use, is that they took the number which ended in the RFS and they've continued to expand it. And in some ways based upon availability. I do not know if that's the process by which folks will continue to pursue the classification, the RFS for biodiesel. But I think that they also have to consider that how much competition it provides in that market as well too, and what kind of pressure it puts on prices.
So let's pivot away from renewable diesel for a second and talk about E15. As you know, we can now sell E15 year-round, and sales have ticked up somewhat. But as was mentioned earlier in the conference, it's still only offered at about 2,400 retail locations nationwide. So in your eyes, where does E15 stand from a market penetration perspective, and what are your projections going forward? Josh, let's start with you.
Absolutely. Man, I love renewable diesel. We got to pivot away. That's okay. E15 faces a lot of challenges, and I don't think there are any two ways around that. The simple reality is, are you going to get consumers to pick up that handle and put it in their cars? And I think what we've seen is that in the Midwest, especially places close to ethanol and biofuel production, there are a lot of consumers who really want to make sure that they are staying close to their local industry and are supporting the local industry. And we see good consumption figures come out of those areas. The reality is there's not a whole lot of actual data around E15's consumption. You have Minnesota that publishes some information, and there's some extrapolation you can do from there. Let's not forget, the Midwest is kind of the heart of ethanol production. And so if consumers in the Midwest see an E15 pump, they are, I think, a little bit more willing to use that pump. That's a challenge when you get outside of those areas. When you get down here where I am in Texas, consumers are much less willing to pick up that different handle. As you get outside of those areas, it can be a little bit more challenging. So there has been the work on labeling that's been done. The new label is, as I've heard it described, less scary, which is, I think, one of those big barriers to adoption is if you pull up to the pump and there's a terrifying label, you're not going to put it in your car. So if you have something that's less scary and it's price competitive, we might see some adoption there. But the reality is, as you get out of the Midwest, I think that there are some consumer adoption challenges that the market just faces.
Seth, anything to add on that?
No, I'd agree. I mean, you look at that first stage of labeling on E15 pumps, and then you think back to, okay, what did you used to see on an E10 pump? May contain up to 10% ethanol. And you'd ask people, are you using ethanol? And they'd say, no, I'm not. Well, no, you absolutely are. So I do think that contrast labeling is going to be an issue, especially when you get out to the coasts where there are more people and more driving.
Sure. Seth, sticking with you, during your last stint at USDA when Vilsack was there, he created the Biofuels infrastructure program to help retailers install equipment to offer E15. And then the latest USDA rolled out a similar program, the HBIP, under a slightly different name, but a similar program, also focusing some on biodiesel. Do you think those kind of programs are going to continue going forward, or how do you see that playing out?
Yeah, so I think, again, I'll go back to, I think, I wouldn't take anything off of the table for the new secretary. The new secretary, he'll want to have all his options. And so, not that anything I say would change that, but I do think that when you look at these rules, like the renewable fuel standard, they give USDA a unique role in this process. And when you think about how EPA pursues things, I think there's a great understanding of its constituencies, the role that biofuels play in both farm income and rural development. I think that there's that understanding. So, I think this department will be engaged in any way it can. And has always played that role when it comes to things like EPA and other programs.
Thanks. Josh, one more on E15 quick, and then maybe we can find some time to get back to renewable diesel. So you're obviously pretty bearish about the uptick in E15, the overall market uptake, but do you think that uptake is enough to offset the downward pressure being put on ethanol demand from electric vehicles?
Yeah, I think there's a lot going on there. So, I think the E15 is providing, and higher ethanol blends are providing a little bit of support. Now, we are especially bearish on ethanol consumption going forward. Like I said, 10.23% of the current gasoline projection is 14 billion gallons. So, we're not too bearish on ethanol consumption over the coming years. And we think that ethanol will continue to take up a little bit bigger portion of the gasoline pool, even as that might decline in the coming years, which could be from electric vehicle adoption or other factors. The reality is E15, we do think it's going to be a slow uptick, and any projections about E15 surpassing E10 as the baseline fuel, I think would be a little bit premature. But it is adding support. We do think that the fact that the blending rate is not 10%, it's slightly above 10%. Well, that comes from E15, that comes from E85, maybe that comes from E25, E30 in certain areas. And we think that will incrementally increase, but it will be a slow uptick.
And at the same time, I again, this is one of those situations where I think you go from short run motor fuel consumption being important to longer run. What's the policy environment to put pressure on this additional use? Tell me what the RFS total volume is going to be. You can back calculate that and try and estimate, is that going to put pressure on the inclusion rate, or is it not going to put pressure on the inclusion rate? And I think that is one of the areas where that will that'll tell us a little bit about E15 development. I think there are definitely challenges, though.
And that core part of the RFS that we haven't really talked a lot about here is RINs. If RINs get expensive and high enough, well, it seems like it's a natural mechanism of the RFS that means you blend more ethanol and make more RINs. Well, you separate more RINs, excuse me. Yeah. So RIN prices right now for the D6s are in the mid 90s, and they're creeping up. There's been some support on RIN prices. Part of that has been due to soybean oil going up, expensive biofuel feedstocks. But, part of it could be and part of it is, of course, expectations around it's possible that there will be fewer small refinery exemptions. But RINs are a core mechanism within the RFS to spur additional blending. If you have a shortage of the physical fuel, you blend more fuel, you separate more RINs, and then you bring the RIN prices down.
And that goes back to my point. The RIN was always intended to be a signal for investment in finding ways to blend more. It was always intended to be that. And so when you introduce these small refinery exemptions, you talk about what D6s are right now. What were D6s 18 months ago, right? And so how do you invest in an environment where the underlying currency goes from 20 cents to 90 cents with with little certainty about where it's going to be going forward? So I think, again, that kind of brings back to that point where policy uncertainty hasn't been favorable to overcoming some of these issues. Those RIN prices are the signal. At the current RIN price, that's a signal to try and blend more. It is a signal to try and blend more, but that takes time.
Yeah, and obviously we had a panel on investment, but as you just highlighted, investment, if you don't know where these are going, it's tough to invest. But you also have to remember it takes time to invest. If, let's say, things were expensive enough that people saw a reason to build additional capacity. I mean, you don't build additional capacity in the blink of an eye. And so you have to have that confidence that credit prices will remain high for several years to spur that kind of investment. And when you have significant volatility, as we've seen over the last 4 years in RIN prices, that definitely makes it a challenge. Now, of course, on the flip side, when you look in the biomass-based diesel space, we touched on the LCFS, but of course, the reason the LCFS has spurred that investment is the high credit prices. They have the annual carbon intensity targets that are published. People know where they are going to be in the coming years. And so you can build some expectations for what credit prices will do based on those targets. And that provides a little bit more stability in where credit prices will be over the subsequent years.
I'd like to think that consistent, having D6 RINs consistently in the 90 cent to $1 range would spur some investment, maybe some of the major retailers to switch over to offering it, but maybe just wishful thinking on my part.
Great. The only thing consistent about RINs is they're going to move.
That's right. Very, very good point. Seth, in the near term, corn and soybean prices have been pretty exciting to watch lately if you're a farmer, not so much if you're a processor. What do you think is behind this demand? Is it real demand? Is it something else? And longer term, what do you think farmers and biofuels producers should expect in commodity prices from your perspective?
So I think that where we've seen prices move probably depends on whether you're talking corn or soybeans. And then I think it's changed a little bit over the last several months. When it comes to soybeans, I really do think it is underlying Chinese demand. When I talk about corn, I think it's largely the fact that we've seen some very late season adjustments on what the size of that crop is. And that's really offered us some price support. And then you add on top of that what are pretty good exports. And part of that also being our competitors don't have as much corn. China has been focusing on corn in terms of taking in that product. So when I think about this, I say, look, you got a smaller crop, you've got a tighter carryover stock for both. China seems to be rebounding quickly in terms of African swine fever, in terms of its overall hog demand. But I don't know that we know for certain, because they're not transparent about what they have for stocks, whether this really is transient demand or have we turned a corner and they really will continue to pull in both corn and soybeans. So when I look at today, I think part of this is we're going to have price volatility because we're in a sensitive place in the market where we've really brought stocks down. We gain or lose big swings in prices of whether it rains in Brazil and Argentina or whether the Chinese come in and buy another 1.3 million metric tons of corn. So we've seen those kind of swings. So folks will be looking at the South American crop, and then we'll switch to the North American crop here as well, too. And I think when you look at current prices and you look at a more normal prevent plant, we would be talking some increase in corn and bean area in the United States. And by the way, as a plug, we'll talk about that at the USDA's Ag Outlook Forum. You'll get our first look at the acreage for the coming year, right? So right now, I think you got a smaller crop, Chinese demand. Is it persistent Chinese demand? Phase one, I tend to think the Chinese buy what the Chinese want to buy. That tends to be my take on that. And right now, they want to buy.
Great. Really appreciate that perspective. Just a quick reminder to the audience, go ahead and type in any questions you might have in the text box there at the bottom of your screen. And Josh, we'll ask that same question to you for petroleum and biofuels prices. Where do you see them going? And to me, it always seems like ethanol lags corn when it's going higher and outpaces it when it's going lower.
Yeah, I mean, I hate to just repeat what Seth said, but volatile, right? There's volatility across the board because the reality is, in some ways, we remain in uncharted waters here. I realize that the title of this panel is Markets in a Post-COVID World, but how does the broad market recover from an event like this? Well, we frankly have never been here, so it's kind of hard to say how the market will recover. But there are some fundamental things that are going on in petroleum markets. You see increased offtake in the Permian Basin, which could provide some pressure on crude prices. So you could continue to see some pressure there. How quickly does demand recover in on-road transportation fuels? Obviously, all the projections have it higher than 2020 levels. So I think we will see some recovery there. We have seen some price recovery in the refined products markets, some support on the crack spreads. But I mean, what's always exciting about biofuels, right, is it's the convergence of these two completely different supply chains. While the petroleum markets are trying to recover from their lows, a lot of the agriculture markets did that in the fall, right? Late summer, they were done, they were back. And so you had biofuel prices find all this support from expensive feedstocks, and you're trying to compete to get into the tank against still depressed gasoline and, on the other side, diesel prices. That was a challenge for a while for ethanol. I mean, you have the statutory floor for blending, but when it came to kind of an octane basis, for the first time in a long time, you saw ethanol not quite as competitive as just as an octane component on a price basis, because its feedstock had gone up so much that all of a sudden you were competing with mixed aromatics that remained still depressed gasoline prices, whereas ethanol had recovered pretty sharply and was more expensive than those. So some of that volatility will remain. In a lot of ways, for the biofuels markets, we're kind of back to the same fundamentals that we were looking at before, right? As Seth was just saying, well, what is the crop doing in South America? What is the crop doing in the U.S.? How are feedstock prices looking? How are my co-products looking? Whereas in the petroleum markets, they're well and truly still trying to decide what is the market going to look like as we come out of this. Are people still going to be driving? Those sorts of questions. And so we have two very different things converging in this moment, which has been very exciting to watch. But the reality is, it means there are no firm answers for how things are going to shake out.
Well, I'm glad that I'm not the only one that thinks that way, right? So, because we talk about in terms of both agriculture and energy, 2020 was really quite interesting because we saw a GDP shrink. But if you look at disposable income, and at least in aggregate, it went higher, right? So these things which normally go together diverged. Now we look forward to 2021. We'll likely have an increase in GDP and a decline in disposable income. And for us folks in ag, that creates a lot of uncertainty in terms of, will the rest of the world see the same thing? Will folks have meat demand? Will they return to driving? Will there be other factors that decline in disposable income converts into issues of demand? And so you add that on top of what we've already seen, and it's going to be exciting. I'm not going to call it very well, but it's going to be exciting.
Yeah, I don't think anyone's in a big hurry to want to go back to their morning commute, but I know people are getting sick of working from home, so it'll be interesting to see how much the driving ticks back up. Seth, sticking with you. Congress has now explicitly given USDA authority to use COVID relief funds to help support ag processors like ethanol and biodiesel plants that were impacted during the past year. So do you think Secretary Vilsack, when he's confirmed, if he's confirmed, will he consider sending some of those funds to biofuels producers or continue to direct it specifically to farmers?
So I tell you what, there's some language within the legislation. I won't box anybody in again, but I tell you that we are already preparing all the materials for the folks coming in and already having those discussions with them about, here's what the legislation says, here are the available funds, here's what's been done to date with CFAP 1, CFAP 2, CFAP AA, how those CFAP, coronavirus food assistance programs, relate to this new omnibus, which included this additional language, and where is the overlap between them. So I can tell you they're already asking lots of questions about this. So they're not sitting around waiting. Those questions will be answered.
I'm glad to hear that. Can you maybe talk a little bit as well about some of the changes that have been made at the USDA to the supply and demand reports, whether it's yield, acres, or demand? Sometimes the ending balances kind of threw the market for a loop. Can you maybe talk about that a little bit?
Yeah. So now, just so you all know the structure here, NASS, the folks that do the WASDE report are essentially NASS's first customer at 6 a.m. So if you have a movement and what I describe as late arriving information, which is late into the season, we see those changes about 6 a.m. and have to go in and make those balance sheet adjustments. And so when you see 400 million bushels less of carry-in, that's got to ration demand. And when I think about this late season adjustment, these are late season adjustments. We didn't see them just in corn. We also saw them in cotton, where you saw some big late season adjustments, not an Iowa crop, but it wasn't unique to corn on these late season adjustments. So I think when you think about this, I think it is natural, and NASS always does this. They'll go in and say, this is an unusually large outcome. Is this a random statistical chance, the narrow possibility of a random statistical chance? Is there something else we need to worry about? Is it not something that we're doing, but something within the system unrelated to, have relationships changed this year that those historical relationships that you use to estimate don't hold as closely? Or is there, they'll call it late coming information, and they will go in and evaluate these late season changes because they were not small, and that's why I think you have seen these prices continue to rally, is because first we had that Chinese demand, at the same time we have a shrinking crop, and now you continue to see it. And right now I'd say corn's being driven by the smaller crop.
That makes sense. Thank you. Josh, I promised we'd come back to renewable diesel, and we've got a question from the audience I think is right up your alley. With the renewable diesel investments we've seen announced, what is your view about the possible convergence of the D4 and D5 RIN prices with D6, and ergo renewable diesel filling the ethanol pool of the RFS?
So I think in a lot of ways we already see part of that. It is almost every single year since I've been looking at these markets, the inter-year spread between RINs is a carry. Next year RINs are more expensive than this year's RINs, always, except 2020 to 2021 D4s. And not just a little bit, these were 2020 D4 RINs were 10 cents above 2021. Now, part of that is, okay, uncertainty around mandates. We already have the 2021 D4, but you do have to realize that the amount of renewable diesel capacity coming online pressured the 2021 D4 RIN. And you did not see that same pressure on the 2021 D6 RIN. So the spread between D4 and D6 for 21 was already smaller than the spread between D4 and D6 for 2020. So we are starting to see some of that. Now, the convergence, how much those converge, I think is a little bit, that remains a question, right? The D5 and the D4, those are real close. Those can range between a couple cents, I'd say, kind of on the wide side, but those will get within a quarter cent of each other. Because a lot of the time, the D4 is functionally the D5. We don't produce enough D5 domestically. We import a lot of that ethanol from Brazil to generate the D5 RINs that are used. So for a lot of the year, you'll see D5s and D4s extremely close together. I don't know if you would see D4s get that close to D6s. I think that would take a little bit of time, given the amount of ethanol that's available in the market. The market does not have any supply constraints to meeting the conventional D6 mandate, right? And so that is part of why D5 and D4 are so narrow, but you don't have that same issue with D4 versus D6. There aren't really supply constraints for meeting the D6 mandate. So I don't think there's reason to think that those would get quite as close. But I do think the spread that we are already seeing for 2021, that sort of narrower spread between the two, it's fair to think that that'll continue.
And part of that spread's going to be that, EPA has got to start with a volume. And then they've got to divide that by motor gasoline consumption to come up with a number. If they try and hit 15, and depending on what they get, 15 billion gallons for the conventional gap, and they try to hit motor fuel consumption, depending on what that number is, that implies a percent inclusion. The higher the percent inclusion, the more that gap between sixes and fours is going to close. And so the challenge will be, what does EPA put into that RFS when it eventually comes out? To me, that's one of the big signals why you've seen them collapse. Is there is that thought, you shrink small refinery exemptions, which de facto raises the mandate, and then add on top of that whatever EPA will say at the end of the day.
Since we're already talking about renewable diesel, I mean, a lot of where we'll see pressure on credits are on those low carbon fuel standard credits. You know, what drove and spurred investment into building capacity to ship to California and any other potential LCFS markets were the high credit prices. But of course, as you have a lot of that supply come online, I think that we will see some pressure on the LCFS credit prices, which we already see in the pricing curve from now to say Q1, Q2 of 2022. There is a slight inverse or backwardation. But what I think is also interesting is going to be the biomass-based diesel tax credit, right? Because now you will also have conventional petroleum refiners also calling for the renewal of the tax credit. When that time comes, obviously it was extended for multiple years this time, but when the time comes to start talking about its renewal, I think you're going to see a lot more alignment because you have both biofuel producers as well as conventional refiners who are now going to be calling for the same thing, because definitely in the balance sheets for investing in these plants, all three of these credits were under consideration: low carbon fuel standard credits, RINs, and that tax credit. So when it comes time for renewal, I think there will be a lot more alignment from both industries.
No, that's one place. I'll say that's one place where there's been more unity on the RFS between oil and renewables has been on the credit side. Not so for other aspects of it, most certainly.
One more follow-up for both of you. I think we got about 4 minutes left here, but there was a Harvard study that came out today showing corn ethanol with a 46% GHG reduction relative to gasoline and a reduced impact on land use change. How do the two of you see this new data impacting the policy discussions at the USDA, EPA, across the administration, and as well as how do you think the market's going to react to it, or does it not move the needle at all?
So I think current regs at EPA would suggest it's great. I mean, it's in terms of, you got two things going on. Currently, the RFS doesn't allow cornstarch ethanol to be anything but a D6 by regulation. Okay, so there'd have to be some potential changes, either legislatively or rulemaking at EPA, to take advantage of those gains in GHG reductions. I think that's part of it, but I also think it plays into, when we think about policy, EPA also needs to put out its vision when it does resets for beyond 2022. And to the extent that corn ethanol GHG reductions are improved, that looks different when you start talking about the four pillars that EPA has to consider when it looks beyond the legislative window.
You know, one of the things that I always think about when I see research like this is how it affects the export markets, because obviously there are several countries that the U.S. does not traditionally export to because there are carbon or GHG saving requirements, namely 50 or maybe 60%. So for me, it makes me wonder if those numbers will translate to those countries adjusting their view of U.S. ethanol, because at some very basic level, you know, I think that the research is very interesting, but it ends up being in the hands of, say, the administrators of Brazil's Renewable Bio program, in the hands of, you know, of Europe's regulators. How do they view that research? Is it going to be strong enough for them to consider how they score U.S. ethanol? And if it is, okay, does that then open that market up to increased imports from the U.S.?
And I think that Japan's a perfect example of that when it comes to corn ethanol score versus Brazil ethanol score, and what they've decided to take in and look at that. Not just taking the RFS 20% GHG reductions as given because that's what's in the legislation.
Okay, we got time for just one more quick one. So imagine I'm a CEO of an ethanol plant, and I have to go tell my board of directors, are we going to be blending more or less ethanol 5 years from now and 10 years from now? How would each of you answer those questions?
More. You know, our analytics group does expect that ethanol will take up a larger share of the gasoline pool in the coming years. You know, we've already talked at length about, well, what is gasoline demand going to do? Sideways, slightly down, slightly up. You know, our analytics group thinks that gasoline will continue to grow ever so slightly, at least in the next couple of years. The expectation is that ethanol will take up a greater share of that gasoline pool, and there will be an increase in gasoline blending.
Is it a Zoom meeting or an in-person meeting? I totally agree with Josh, which is, you expect as gasoline rebounds, you'll continue to grind that inclusion rate higher. But again, in the short term, your board cares about the short term. Are folks driving more or aren't they driving more? But I think he's right. As you go forward, you grind a little bit higher. I think longer run, you get the challenges of CAFE standards, EVs, and everything else when you look out beyond that, say, 5-year horizon. But yeah, is it a Zoom meeting or are we all together having lunch?
Well, thank you both for this great conversation. This was very informative for me, and I'm sure it was for everyone else. And everyone in the audience, feel free to use your hand clapping emoji in the comment section to thank our panelists. And please stay tuned for the next panel, which will be discussing export opportunities for biofuels. Thanks again.